features of Alan's presentation was, looking forward, very much a government focus on increasing revenue rather than reducing expenditure. And we've seen a number of changes to taxation treatment, particularly around closing what the government would see as loopholes around business tax. Just interested in a bit more detail on that, your views on that, and how you think business might react to those changes.
Well, it's interesting. Last year's improvement in incentivising the economy and international competitiveness is this year's tax loophole and aggressive tax planning. So a lot of the changes that have occurred really are wind back of government policies from previous activity. The reality is I think business will adapt. I think most of what was announced last night was expected or had been forecast or leaked previously. Having said that, there is $4 billion of changes coming through these loophole announcements. The major ones are thin capitalisation restrictions, which will raise about $1.5 billion, $1.1 billion for mining exploration right deductions being deferred, and about $500 million on an attack on some of the tax consolidation outcomes. So the impact that's going to have on the economy, if you're an inbound or outbound investor, you will be valuing some of your asset acquisitions differently because you may have some tax denials with the safe harbour for ThinCap coming down from 75 down to 60%. I think also the big hit or the big burden of this will be on existing projects. So if someone's already financed a large project expecting to get a deduction at 75%, their after-tax outcomes are going to be much worse now if they're getting interest denials. The silver lining is you can still rely on what's called the arm's length debt test, and that's really important for sectors like infrastructure, which has always been able to bear more debt. So with the increasing need for infrastructure in Australia, that is a positive going forward. One of the other changes is to the mining sector. So you used to be able to claim an outright deduction for acquiring mining rights. The government's now said you can get that deduction over 15 years or less if you've got a mine life less than that. Again, the impacts of that is you'll expect to see that the acquisition of mining rights will be valued lower now because of the deferred tax deductions you're going to get. And Australia's going to be less competitive internationally when people are lining up whether you invest in a mining right in Australia or an exploration right somewhere else. Look, overall, I think the government said we need to get some money somewhere, so it's worth the risk that some of this funding might go offshore.
And we've also seen increases in personal taxes or levies, as they may be called, and an increase in kind of administration burden for many taxpayers. Have you got a perspective on that?
Well, yes. I suppose it's not that surprising that business has copped it a little bit in this budget. It is perhaps a little surprising in an election year that individuals and superannuation and administration has been a focus also. The Medicare levy is obviously the big one. Everyone's going to bear the brunt of the 0.5% increase, and that's $11.5 billion over the forward estimates. There's $1.5 billion that's come out of some of the carbon tax compensation, but as Tom said, there's still a lot of compensation in there that hasn't been touched. Ultimately, though, I think if you look at it differently, it's perhaps not that surprising because more than 45% of the government's total tax take comes from individuals. Given how bad the estimates of company tax take has been, and given the need to fund really big spending initiatives like the NDIS and Gonski, you really wouldn't expect the government to rely only on corporate tax take because it's just been so woeful in the past. Having said that, it's an election year. It's pretty brave, I think, for individuals to be hit with tax increases.
All right, thanks. Alan, there was a couple of points in your presentation that I wanted to tease out a bit more. The first was a quite big difference between your view on GDP growth this year and the Treasury view. So I'm just interested in the ramifications to deficit and so on if your view plays out rather than the official view.
Yeah. And I know Tom said you can't understand the difference between nominal and real. It's actually important in terms of your budget numbers because in real, what they're doing is they're essentially deflating by inflation, and nominal is the world we live in. Now, what's actually happened is because the terms of trade have come off and the currency stayed high, the price deflators have been really low, and so they get less profit. Now, if we're roughly right and we're about 1% lower over the next 18 months in nominal because we think the currency is staying high, terms of trade coming down, that's probably worth around $10 billion to the bottom line. Now, these things will move around a lot, but what I'm sort of saying is I'm particularly worried about what's happening in 2017 and 18 when all these things really start to fire up. But I'm also slightly worried that they're going to do what they've just done again, because I wouldn't have liked to I'm not seeing any real reason as to why nominal GDP should be recovering so quickly. I don't see profits being strong. I don't see people paying a lot more tax because the economy's doing well. And in the personal side, outside of the levy, which is sort of compulsory, people are still basically carrying essentially tax losses forward. And yes, house prices have improved, but capital gains tax is not going to raise a lot of money.
So I think if my mental arithmetic is broadly correct, if you're right and the government's wrong, this could be a variation of up to 50% in the deficit in the next 12 months.
Oh, yeah, but I'd just say it's more like 10 billion.
Yeah.
So instead of something like 19 or 18, you could be mid-20s, high 20s.
That's a big number. The other theme that came out in your presentation to me was that kind of consumer spend is one of the strong and high points of the economy at the moment, and that obviously feeds through positively for many of the business people in the room today. Key drivers of consumer confidence, in my view, are around employment and interest rates. Your view on unemployment is a little negative. Yeah. And I think, again, I'm just interested in your views on how that could feed through the economy if it becomes real. And more importantly, perhaps, is what do you think the government could have done today or yesterday to start to address this trend?
Well, in terms of unemployment, that's the thing that will flatten out house prices. That's the thing that will make people feel nervous. And that's also, people get very nervous about not so much the level of unemployment. When it starts moving one way, they worry that this might be my job. What could the government have done in some simplistic way? I think what they should have done was adopt the sort of policy that they did last year. Because last year, remember, they took around 1.5% out of GDP. Nominal, real, whatever way you want to look at it. They took 1.5% because they told everybody we need to have a surplus this year. And don't care what it does to the economy, I will basically take it out. And the sort of subplot was, oh, and the Reserve Bank will fix it up anyway. Now, I don't think that works like that, because just because you cut rates by a little bit doesn't fire up business to say, right, I'm going to go and borrow from the banks and fire up credit demand. People are still nervous. People are still paying off their credit cards. Their businesses in small business are not showing huge increases in demand for credit. So I think this fetish with a surplus has done us real harm. And I think as we go forward, at least the sort of harm hasn't been multiplied. That would be the good part of last night.
Okay, thanks, Alan. Well, what we'll do now is open up for questions. There's microphones in the room. If I could ask you to put your hand up, we'll get a microphone to you. If you could then identify yourself and ask a question. There's a lot of people here, so I'm sure there's questions. So if someone would be kind enough to kick off with an initial question, that'd be great. Well, we've got 10 minutes. It's going to be very, very awkward silence. So surely there's a question out there somewhere. We have a question up the front here. Thank you. We'll get a microphone to table 11. We're getting a microphone up the front here. Thank you. No, it's a big room. They won't hear you, I can assure you. Is there one up the back? Okay, we'll start up the back whilst we get a microphone down the front. Thank you. Okay, thank you.
Sarah Pantarella Bokera. My question is in regards to China. I mean, I understand they were growing at 10%, now you're predicting 7.8%. But 7.8% of a huge economy, in my mind, is still brilliant growth. Why is it doom and gloom?
Ella?
Yeah, it's not gloom and doom, and that's the bottom line. It's to make some further points in terms of what you're saying. If you've got an economy that's the second biggest in the world and it grows at 7 or 8%, it sort of adds a Korea every year. So it's not small. I think the way you should interpret China is the way that I used to learn when I worked at the OECD. What we used to say is, think of, let's call it Australia, whatever China publishes, given their population and where they are in terms of catch-up, subtract 5. So for them, if they were growing at 10, it'd be like Australia growing at 5.
at 7 3/4 or 8, it's like Australia growing at 3. It's only when it gets to 5, which is what they did during the global financial crisis, they went out and spent 13.5% of GDP on a fiscal package. So this is not a bad story, and that is going to feed back into the idea that people will still want to have a diversification into China via Australia. And it also means that the mining demand for things like iron ore is still there. And, you know, there are froth and bubbles out there all over the place, but the core guys in Australia, iron ore, we can put iron ore into China at $50 a tonne. Current price is $135 a tonne. That's pretty good. So China is slowing, people get nervous about it, but it's still, if you like, a positive outlook. It's just not quite as strong as it was before.